Hello, thank you for joining me, Fiona Cincotta, here at StoneX. And today I have the pleasure of being joined online with John Kicklighter, Head of Global Content at StoneX. Thank you very much for joining us today, John.
Thank you for having me.
So let's dive straight in. Obviously, there's so much been going on in the markets. And just with recent shifts in global economic policies and market sentiment, which macro themes do you think are most critical for traders and investors to watch? And how do these themes shape your views of emerging opportunities and risks?
We have so many competing themes going on right now, and it's very difficult to see which ones the markets are going to track. I think we've seen just in the past couple of weeks a shift from concerns around global growth, recession risks are reappearing. We have concerns over the outlook for monetary policy with the Federal Reserve supposedly leveling out and the uncertainties there. And of course, we have trade wars, which this is not the Trump 1.0 trade war. This version of the trade war seems to be even more difficult to follow in terms of whether these tariffs are going to be introduced or they're not, whether they're reversed, who it's impacting, industry or economies. And typically, I would say that that trade war, the uncertainty, is the biggest price risk. So it's very difficult to price in a course of something that is so erratic, and usually that's where most of the repricing happens in markets. That being said, I think the markets are just so whiplashed by the back and forth in the headlines that it is almost impossible for the markets to really take it seriously, to price and establish a trend around that particular theme. And I think what you're starting to see is the markets are growing calcified, hardened to the headline whiplash, and that's leading the markets to just revert to other themes. So just following the economic calendar, we just had the FOMC last week, and now we're heading into the PCE deflator towards the end of this week, which is the Fed's favorite inflation indicator. You have some contrast in interest rates. So I think interest rates are definitely on that forefront. But the concern over growth is probably one of the most comprehensive, rudimentary, fundamental themes that you can revert to as long as it's interesting. And the concerns that we have around labor trends, growth through exports, consumer health and confidence, those are certainly themes that are starting to sour. And the more traction it gets, I think the more it stays in the center of our focus. And we end up shifting towards a focus on growth. And if that's the case, you're not seeing it as being exceptionally robust growth. We've already had that trend in previous months. It's more so what the risks are to growth going forward.
Yeah. And I mean, adding to that point, it's really interesting because what Federal Reserve Chair Jerome Powell said last week was, highlighting the uncertainty of how it's going to be impacting or how those trade tariffs are going to be impacting the economy. He said, it's difficult to see how this is going to pan out. And I think that was sort of also obvious in or evident, should I say, in that mixed forecast that we got: increasing inflation, reduced growth forecast, yet they're maintaining that 2 rate cut outlook. So, yeah. And how do you see ongoing trade tensions, especially between major economies, affecting global growth forecasts? And what implications does this have for retail trading strategies?
It's the uncertainty of it all. I think that there are very clearly direct trade tariffs being raised by the Trump administration against China in particular, but also Mexico and Canada are going back and forth, although some of those are applied and reversed and threatened, applied and reversed and threatened as a cycle. So it does add a lot of volatility to an exchange rate like the US dollar, Canadian dollar, the US dollar, Mexican peso, and obviously the US, Canadian, and Mexican asset classes. But I think that the US China relationship is just consistently deteriorating. And I don't think it necessarily is going to have an easy correction. The problem that they have is China is trying to grow, it's trying to grow internally, but it really doesn't have the capacity to do so. Its policies are kind of at loggerheads. And subsequently, they have to really double down on the supports that they get from exports and some of the trade advantages that they get through exchange rates and the like. So I think that that's going to keep the Trump administration really pushing. The funny thing is dollar CNH, for example, the dollar yuan is not a very active exchange rate because it's managed by some of the regulatory bodies in China. But you see some interesting activity through, let's say, the Shanghai Composite locally in China, or the FXI is the ETF that trades in the Western economy that approximates the large cap Chinese markets. I do think that those and the assets that are byproduct of these trade tariffs. Oil, gold as a haven, as we question the stability of traditional FX or fiat money. Those are definitely going to be absorbing a lot of this back and forth. Whereas dollar CAD, for example, it just does a lot of volatility back and forth and doesn't really approximate a trend. So when it comes to the shorter term retail trader looking for that volatility, being very mindful of headlines and news updates, but not really assuming the of a clear trend. If there is a trend that arises out of all of this and it's unresolved, trade growth, inflation, interest rates, it's probably not going to be a really robust bull trend. I mean, one can certainly crawl its way through all these uncertainties, but if there is a really decisive move from benchmark capital assets like the S&P 500, it's more likely to be a risk off because that's easier to approximate fear amongst all these uncertainties than it is greed, which is the opposite end of the spectrum.
Yeah, completely. And it does almost feel like in order there to be that reversal towards risk on, we need to see a pivot either from the Fed or from Trump. And it doesn't feel that either one's sort of a decisive move coming anytime soon.
Absolutely.
Central banks, they're walking a very tight line between rate hikes and controlling inflation. How should traders interpret these rate decisions in the context of persistent inflationary pressures and rising uncertainty?
The contrast between uncertainty and inflation is going to be a problem for a central bank like the Fed. Unfortunately, the Fed is the largest major central bank and it sets a lot of monetary policy expectation for the entire globe. Uh, in contrast, you have a number of central banks that have actually stated that the trade wars that are originating in the US are inflationary for their local economies. So they're saying that these actions are impacting their own interpretation of monetary policy, and the Fed is saying we're neutral, which is an interesting contrast. But I do think that you will probably see inflation pressures start to pick up. Obviously, we're going to see some erosion of growth outlooks. We do have, I think, the IMF's World Economic Outlook update next month. But that kind of contrasting pressure, rising inflation, softening growth. I won't say stagflation because it's a little bit of an extreme of that scenario. But I do think that if these other major central banks, like the Bank of England, the European Central Bank, the Bank of Japan, if they say inflation is more important to us in controlling that than supporting growth amidst trade uncertainties, then I think it's going to kind of pull the Fed into having to follow suit, even though it's unclear about its outlook with these trade uncertainties, as you said, which was repeated by Jerome Powell in his testimony or his press conference following the rate decision last week.
Yeah, excellent. And finally, would you say that markets seem to be sort of shifting their focus from traditional growth drivers to more defensive posture due to these geopolitical tensions and unforeseen events? How do you think traders can affect or adapt their strategies to this ever evolving environment?
Yeah, for people who are, I think, in the investor class, so a longer duration, this is very difficult times because you prefer low volatility and low volatility of volatility. I mean, you don't want these uncertainties to arise out of the blue, but the probability that one does is very high, which means that your buy and hold kind of approach is going to be more fraught with these competing macro influences. So the best thing I think to do, if as long as you aren't in it for 10 years, hold buy and hold kind of retirement kind of approach, then I think that shortening duration and expectations for objectives is probably the order of the day. Be a little bit more defensive in terms of the time that you expect to be in that trade. If you're expecting it to run 500 points and it would be 3 months long, maybe consider it for 100 points and only 3 weeks, because that's more practical to the current conditions that we are facing.
Yes, almost sort of being more nimble as well in that respect, to be able to react to the different headlines as they seem to be coming out thick and fast from Trump's
Mhm.
administration. No, that's brilliant. Thank you so much for sharing your insights with us today, John. Extremely insightful, and we look forward to speaking to you again soon.
Thank you.